Hello and welcome to Capital Ideas TV. I'm Mark Bunting. This is the show where we give you access to CEOs of innovative growth companies and investment ideas so you can magnify your returns. One of those CEOs is Sean Morrison. Now, he pioneered the multi-royalty strategy in Canada in the late 1990s. The company recently bought the trademarks to Air Miles Canada, which should really move the needle on revenue and earnings. This company also pays a dividend yield of 7%. Here's our conversation with the CEO of Diversified Royalty, Sean Morrison. Sean, you helped to usher in this multi-royalty strategy, and you've really developed it, but there are still those who may not exactly understand it. So explain and describe the model, and why is it good for business owners? Why is it good for investors?
Yeah, it's a complex structure and transaction, but at the end of the day, we're buying the trademarks and top-line royalties from great multi-location businesses. And the business model is really to own a diversified pool of royalties from a bunch of high-quality businesses. So we're in the early stages. We have 3 companies right now, and Sutton Realty, Mr. Lube, and Air Miles, 3 of the best brands in Canada. We get a top-line royalty from their business.
Let's focus on Air Miles Canada. That's your most recent one. That's a name that most Canadians know. In fact, great penetration, something like 98% awareness there. So what attracted you to this business? What do they bring to the table, and how's it going to help you?
Yeah, actually, quite frankly, didn't even know Air Miles was a candidate for a top-line royalty fund. The trademarks on top-line royalty were owned by Aimia, and obviously we know Aimia was hit pretty hard when Air Canada gave notice of pulling from their contract. Aimia put the business up for sale, or the trademarks up for sale, and we're a business that buys trademarks and top-line perpetual royalties, and that's exactly what they had for sale. So we had the unique opportunity to buy a spectacular business. It's run by a company called Loyalty One that generates $800 to $900 million a year of revenue and $200 million of EBITDA, and we get a top-line royalty on that business that only pays us $8.5 million. So we have 20 times coverage on our royalty. It's about as good as it gets.
So tell us and tell investors what they could expect from Diversified Royalty in terms of revenue growth and earnings growth the next year or two, let's say.
Great question. I mean, investors have been waiting about 10 months for us to announce this next deal, and obviously that was the Air Miles transaction. We earn about 21 cents a share. We pay a dividend of 22 cents a share approximately, and we have $33 million of cash on our balance sheet to do the next deal. So our objective now is we have 3 top-line royalties. Our objective is to kind of over the next 12 months buy 1 to 3 high-quality royalties to build that pool out and make it a much larger business, more diversified. And we think as we grow the business and make it more diversified, that shareholders will get a steadier, more stable income stream. We should trade at a lower yield, and hopefully if we do accretive acquisitions, our dividend should increase, and the combination of lower yield and increased dividends should be good for share price and shareholders.
You mentioned the $33 million in cash. What are your parameters when you go to look for a company? And I'm wondering also secondarily, based on your investment banking background and this current private equity group that you have, do you almost have the perfect skill set to identify these companies?
Yeah, I mean, I kind of came up with a top-line royalty structure, multi-business royalty structure in '98. So I feel like I've been kind of at this for about 20 years now. Obviously, this public company, being Diversified Royalty Corp, has really hit its stride in the last 3 years. The $33 million worth of cash on the balance sheet, we can lever up conservatively, so we think we can do about a $50 million transaction. And similar to the first 3 deals we did, we're looking to buy a high-quality trademark and royalty stream, and in the $50 million range would be our preferred. So we don't have to raise any capital at these share prices. We think there's lots of upside in the share price, and we want to deploy our cash on the balance sheet to realize that.
Is it always a battle to try to educate the market as to what you're doing here, even though you say, as you say, you've been at it for a long time?
Yeah, I think the market, on the market side, I've done a ton of work over the last 3 or 4 years meeting with institutional investors. We're kind of just starting the retail segment of the pitch today, and because our story is easier to sell. But I think the opportunity is huge. I think we can double the size of the business in the next 2 years, and if we can do that, I think we can create a bunch of shareholder value.
You've got 7 analysts covering Diversified Royalty. Many of them say you're trading at a discount to peers and that you have significant upside. I'm guessing you'd agree with that?
I do, but it's more fact-based. I mean, we have 3 royalties that are as good or better than our comps, which are A&W, Keg, Boston Pizza, and Pizza Pizza. They trade at an approximate dividend yield of about 5.5%. If you consider the cash that we have on our balance sheet and take that into consideration, we're trading in the high 7s. So we think our royalty stream is as good or better than the comps. Our royalty stream also comes with a management team that our objective is to grow the business and add royalties on an accretive basis to the pool, and we think that combination of a better quality royalty stream and more growth through acquisitions should lead to a decrease in yield and obviously therefore an increase in the share price.
Sean, is there anything we haven't touched on you'd like to get across?
Yeah, I mean, I think we're trying to buy trademarks from really good businesses. So when we are out there pitching these really good businesses, we can point to A&W, Keg, and Boston Pizza, and we can show how good to those businesses this royalty structure really is for them. To investors, we can show how good those investments have been over the last 15 years. I think the combination is unique. Owners of great businesses are not in a rush. If they do nothing, life is good. My job is to kind of let them know that this is an option for them when the time is right. And that's why we're trying to do 1 to 3 deals a year. You can't force a deal. You're better off waiting to find a really good one.
Hi, I'm Mark Bunting. Join me every week for Capital Ideas TV as we interview the CEOs of the most innovative growth companies in Canada. Get early access to great investment ideas. Peekaboo Beans is not your mother's Avon or Tupperware. This company, founded by entrepreneur Traci Costa, takes that door-to-door sales model and puts it online, so stylists can run their own businesses by selling quality children's wear. The company says it's on the verge of hypergrowth. To find out why, here's our conversation with Traci Costa. Traci, describe Peekaboo Beans for us and how it's different from what we know of the sort of the Avon model and the Tupperware model.
Peekaboo Beans is the most unique and emerging children's apparel and lifestyle brand. It embraces the power of play and empowers women and parents to have their own entrepreneurial opportunity. So we are creating a retail disruption by creating distribution through people, like the Airbnbs and Ubers of the world. So we are able to pop up shops, mobile boutiques in homes all across North America. So we're reinventing the old school model of the Avon or Tupperware, and with social media, we can really disrupt that.
Now, I've heard you talk about how you think your company is on in the midst of hyper growth with a low-cost model. What does that look like? And take us through sort of the revenue projections and the stylists you're adding and what rate and so on, margins. And you eventually hope to be profitable next year, 2018.
Yeah, absolutely. So we have spent the time and money and building the infrastructure in Canada. We have over 1,200 of our independent reps, or play stylists as we call them in Canada. We have built that infrastructure from the compensation plan, how we pay our reps, to the software, how they run their businesses, and we have that infrastructure in place. We are now launching into the US. We just closed a financing of $2.1 million in June. This year we'll close off just close to $4 million, and next year we'll grow to $8 million in our projections. And that's where this hyper growth starts to happen.
And then going out to 2022, it's even more. You're looking to grow by leaps and bounds.
Well, when we talk about this low-cost business model, it doesn't cost us like traditional bricks and mortar would cost and have that capital requirement or that capital need to grow the business. We can grow exponentially at low cost because we're just using that network effect of people coming on, stylists growing their businesses. So that's how we grow. We grow by bringing on more independent reps, having their own business and sharing that opportunity, and they're bringing on more and building their teams out. But it doesn't cost us from the corporate infrastructure. And that allows us to grow quickly.
Right. Now you've got the U.S. expansion going on. Give us an idea and a sense of some of the other projects and initiatives you're working on right now.
Our big initiatives are obviously the U.S. expansion. That is in full force right now. The team is working hard at that, and that will be happening, as I said, this month. The two other big pieces that we're working on are improving our gross margin, which we have initiatives rolling out in our spring-summer collection with new partnerships that are going to help with our cost structure. And then profitability is our next focus. So 2018 is all about growth, it's all about profitability, and it's all about adding to the top line.
Investors love it when executives and other insiders have stake in the game, which you do. Give us a sense of that.
Well, our share structure is a nice tight share structure, just over close to 11 million shares with insiders owning 20%. It's a very tight group of shareholders that have really invested in the brand and in the possibility of this hyper growth and expansion into the U.S. The U.S. market, the direct sales industry is a $36 billion industry. And if you look at the direct selling stats, 1 in 7 households has a direct sales business. There's only one other children's apparel brand in the United States that's doing this. And their revenue over the last 5 years has been about 90 million in revenue. So we're entering a marketplace that is very acceptant of the direct selling space. Again, like I said, the Ubers and the Airbnbs are really transforming that distribution and saying that, well, we can create distribution in people. And so there's a significant amount of opportunity as we're moving into the U.S.
Now, Traci, you've touched on some of the aspects of your company, but when you talk to investors, what do you say to them in terms of convincing them that this is you've got a really strong investment case and it's a very viable investment?
Yeah, absolutely. Well, there are several points that I would touch on. One is the retail environment is going through a transformation with a lot of bricks and mortar stores going out of business. You see it on the news every single day, retail bricks and mortar stores closing down their businesses because that cost structure is just so enormous. Then you're competing with the Amazons of the world. And at the end of the day, people still want to have that human connection. So Peekaboo Beans is creating a retail disruption. And if you think about the Ubers and the Airbnbs, we're creating distribution through people, and we're providing a quality customer service experience with a human solution by allowing these people to have a mobile shop in their home all across North America. Second of all, we spent the last 5 years building the infrastructure in Canada. So we've proven out Canada. We have 1,200 reps that are generating close to 4 million in revenue now, and we've set the stage now with all the infrastructure to the move to the U.S. And then we've raised capital. So now we have infrastructure where we raised $2.1 million. So we're capitalized, and so that's really taking a lot of the downside risk out as well. Further to that, if you look at the components of a successful direct sales companies, there's 3 critical components. To have a quality product that has a brand story and a unique product appeal. The second is to have a world-class product which pays your field well. And the third is to have a mission, vision, and a story that retains people. Peekaboo Beans has a quality product, amazing lifestyle brand that really is supporting the development of children and focusing on play. The second is that we invested over 9 months in building out a compensation plan that pays our reps upwards of 35% in commission, as well as they build their teams, they can earn passive commission. And third to that, our retention piece is probably one of our most powerful pieces, and that is that we're really about preserving play in the world. Children are spending 7.5 hours in front of technology and media devices a day, and our mission is to get kids playing and back to learning through play and giving them that, letting them be children again. And that is a big retention piece. When you're speaking to parents, they really want to empower their children with that. When you put all of those things together, you're really looking at a recipe for success. So much of the downside risk has been taken away, and we're moving into a massive market space. As I said before, the U.S. direct sales industry is a $36 billion industry, and 1 in 7 households has a business, a direct sales business. So we're well positioned, and it's the perfect time for someone to get involved at this low valuation.
Now you're excited about your business, you're passionate about it, you're getting the word out. Free publicity doesn't hurt. So you dressed the Prime Minister's family. How did that come about, and what kind of feedback did you get on that?
Well, it was fantastic. I received a call from their stylist and they wanted Peekaboo Beans to outfit their children for Canada's 150th birthdays, which was quite an accolade, given that it was going to be in front of worldwide media. So we custom created outfits for all 3 children, and there was pictures taken with the Royals, there was pictures taken with Bono and U2.
Wow.
So it was really exciting for us. I mean, any type of product validation, especially when it's unsolicited, is fantastic.
And did your phone blow up that day?
Oh, it absolutely blew up. Yeah, so it was really, really great. And we look forward to more of those opportunities. I think that's a testament to our product, first and foremost, and it's a testament to the values that our company generates. Well, Peekaboo Beans is a lifestyle brand. I was fundamentally confused why there wasn't an apparel product that fostered a lifestyle of play for children. I want the world to look at the lifestyle of a child as something that needs to be preserved and protected. And we create an apparel product that makes them feel good. It allows them to get outside and become who they are. And that's what we want. We want to foster a playful life.
Globex Mining Enterprises calls itself a mineral property bank. It owns more than 150 assets in precious metals, polymetallic metals, and specialty minerals. Now, the longtime CEO of the company, Jack Stoch, admits that sometimes it's difficult for investors and Bay Street to get their heads around the story and the business model. To shed some light on Globex Mining and why he thinks the shares are wildly undervalued, here's our chat with Jack Stoch. Jack, Globex Mining is a mineral property bank. Explain what that is.
Globex specializes in the acquisition, the inexpensive acquisition of assets. What we do is we have a good understanding of mineral properties. We go out and we, over time, with a long-term vision, acquire properties cheaply. And what we do is we take that initial investment, we add our intellectual capital and some physical work, make the value evident, and then we transform the property into revenue by doing deals with other companies where they pay us to try to acquire an interest in our projects. And then if they go into production, we end up with a revenue stream.
Let's talk about some of the assets you're excited about, namely in Germany. You just struck this deal, and this is a very famous and prolific mining area, especially for silver. What do you have there?
We picked up a major land package in what's called the Freiberg Silver District. It's a historical silver producing area, has a history of over 850 years. We picked up a package, it was 164 square kilometers, 36 kilometers long, covering a 35 kilometer long silver bearing horizon and vein system, 5 kilometers wide. It has 6 former silver mining camps and 5 other areas with known silver mineralization. The cool thing about it is it's not only silver, it's also zinc, it's also lead, it's also copper, there's a bit of gold, there's fluorite and barite, and potentially graphite. So it's a really interesting package. Oh yeah, sorry, and tin. So it would be basically a polymetallic horizon, but principally silver.
Speaking of gold, which you did there, back in Canada, near Rwanda in Quebec, you have a gold project. Update us on that. What kind of work are you doing there?
Yeah, well, we have a 7 kilometer stretch of the Wassa Fault with 6 former producers on it. 5 are the Arnfield mines and 1 which is the Francoeur mine. We have recompiled a lot of the existing historical data, and we came to the conclusion that particularly on the Arnfield part, that there was, the work that was done and the mining that was done was on a quartz vein system, and the country rock per se was ignored. So we've just completed 6 trenches over 1,000, or more than 1,000 feet of strike length. And we've washed them, we've channel sampled them, and we've put them in for assay. We've just got the results of the first trench that we did, and we'll be putting out a press release on it. It's much better than we ever hoped for.
Now, Jack, give us a sense of Globex Mining's revenue generation, and specifically as it relates to this Tennessee asset that you recently picked up.
Globex has a variable revenue stream. It depends on what market conditions are like. And when market conditions are bad, we're in the acquisition mode. When market conditions are good, we're in the option mode, and so on. We have revenue from options, and we have revenue from royalties. Right now, we have a royalty revenue stream from a mine in Tennessee called Mid-Tennessee, which is actually 3 different mines. It's a long life area. It's already operated for over 50 years. It has ore outlined already for 23 years and much more. There's a lot more mineralization known. And basically we end up with, at the current metal prices, 1.4% gross on the production. So,
which is zinc.
Which is zinc, and we're expecting that that's going to be somewhere in the range of, there's no definitive number because it depends on their production numbers as well as the metal prices, but somewhere in the range of about $2 million a year. We're projecting this year, because the mine just started up in May, that we're going to have gross revenue, if we do no more deals than what we've done already and which are ready to be signed, plus this revenue stream, we're expecting something like $3.5, $3.6 million in gross revenue this year. So that most juniors don't make any money, we make money.
The stock market can be a chaotic place. Do you want to stand out from the crowd? Watch Capital Ideas TV. Never be the last to know. MedReleaf has only been public for several months, but already it's one of the largest licensed producers of cannabis by market cap. It's also the only one in North America certified to produce medical-grade cannabis. The CEO is Neil Closner. He says that compared to peers, MedReleaf has a superior cost structure and has among the highest profit margins. Here's our chat with Neil Closner. So, Neil, you say that you set the medical grade standard in the cannabis sector, and you're also certified by a couple of bodies. So explain what you mean by that.
Well, when I began the business in 2013 and got our license in 2014, I set out to build a business that was focused on the medical side of the market, which at that point and still today was the only legal element of the Canadian business. But I wanted to bring what I had known from my background, which was I came from a hospital setting where I was a senior executive, and a number of members of our team also joined me from there. And we wanted to bring analytical rigor to an industry that at that point had sorely been lacking those elements, right? So the touch points for us, or the validation points, are what you mentioned. We're the only ISO 9001 and GMP certified cannabis producer in North America. And that fits in well with our, what we say is QA, or quality assurance, is in the DNA at MedReleaf. And so you put all those pieces together, and it's helped us build a business that has the respect of physicians and patients.
How do you come up with and innovate to make different strains and to keep yourself ahead of the competition and differentiate yourself?
Well, we began with a really good set of genetics, and that helped us in the earliest of days and continues to help us. So really that's 2 pieces of the puzzle. We had an exclusive arrangement with the leading medical cannabis producer, arguably one of at least in the world, from Israel. And we had the benefit of some of their genetic material in the earliest of days. And we also began with our own genetic bank, if you will, of hundreds of different strains. And it's from all of those that we've managed to continue to iterate and develop new products, in part that are driven by results that we receive from our patients. So we have a substantial analytical effort in terms of understanding which particular products are working for our patients for particular symptoms. And then we go back to our plant geneticists that work for MedReleaf, and we try to devise strains that overexpress in those particular chemical elements that we believe are the ones that are driving the positive effects in those people.
On the financial side, Neil, you say you've got the highest selling price in the sector, you're the most profitable at MedReleaf, you've got very strong margins. So how do you do that? How do you manage that?
Well, there's 2 sides to that, to the margin coin, right? There's price and managing costs. So we produce what we believe to be the highest quality product in the country. So we produce indoors. Indoor product tends to achieve a higher retail price, not just in Canada as we've shown, but elsewhere in the world as well, in the other more mature markets in the United States, for example. So we produce a higher quality product that achieves a higher price in the market. And then we've managed through a process that we've devised of constant iteration and operational improvements to drive down our operating costs to the point where we're actually operating with a cost of goods that's on par with greenhouse producers, but our product, because it's grown indoors, is of higher quality and gets a higher price. So that's how we have that added cushion, if you will, in the middle, or the margin, that drives our profitability.
You mentioned greenhouse. That makes me think of Vic Neufeld, whom you know,
Sure.
whom we've had in here from Afria. He would say, I've got the lowest cost. So what do you say to that? And what about the difference between what you do with indoor and with him and greenhouse?
Yeah, so I mean, Vic and Afria run a great business. They do have quite low operating costs from a comparative perspective. Our costs are approaching his. But as I said, so if you look at his and you look at ours, we might be a dime or two higher than his, but we're getting $1 or $2 more on retail price. So in my opinion, I'll take that trade any day.
Okay. So in your last quarter, cash cost per ounce actually came down quite a bit, but then earnings were a bit lower year over year. Average selling price a little bit lower. So tie that all together for us.
Right. So we happen to have been a very early leader in focusing on treating Canada's military veterans with post-traumatic stress disorder, and they happen to be one of really the only group of patients in Canada that have insurance coverage through the federal government. And so we've come to really understand that patient base, and we have terrific products that are driving tremendous results for our military veterans. And the government made two fundamental changes to that program, one in November of 2016 and the second in May of this year, that adversely affected the reimbursement rates. So for someone like MedReleaf, for a company like ours that has about a 50% relative market share in that industry, it had a more pronounced impact on our bottom and top lines as those changes came into effect. And those changes were a cap on price and then a cap on quantity that could be sold to these individuals. So we've managed through that. We've kept our top line actually relatively stable despite the fact that those were substantial negative impacts on our business. But we still are very committed to that patient population, and I think from this current quarter onwards, I think you'll start to see the growth begin again. On the top line, we are still a very powerful growth engine in terms of a business. All other elements of our business are growing tremendously.
So lastly here, Neil, do you think that the market understands your story well enough yet? You've only been public for several months. There are a lot of marijuana companies out there. How do you stand out?
Listen, I think every CEO that you would probably interview would say our company's undervalued. I think on a relative basis, there's some additional educating that I think I and my team need to continue to do. As you've said, we've only been public for a few months. Many of our competitors who have been public, they've been public for quite a bit longer than us. So they've had time to educate the public markets about what they do. I believe on a relative basis, we outperform almost every other player in the country. So, you know, certainly in terms of margins and profitability, you know, it's that part of the story that needs to be better understood. And I think, you know, given time, that will happen. And, you know, we just keep our heads down and build our business. That's what we've done up until now and we'll continue to do. And the stock price, we believe, will just take care of itself.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our YouTube channel so you don't miss an episode. And for more excellent research and great investment ideas, subscribe to capitalideasresearch.com. You'll get our weekly digest and morning note. Thanks for watching, and thanks for investing like a pro. We'll see you next time.